Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy investment advisor Ross Clark talks about how Trump appears to be backing down on his election promises and how that's affecting the price of gold. Inside Track President Eric Hadik warns other airline stocks could fall because of the United Airline passenger ejection fiasco. He also believes the U.S. dollar could be in for tougher times. Kaiser researches. John Kaiser will tell us about junior mining stocks and where he sees potential in them. And at the end of today's show, we'll have a company showcase update with American Manganese President and CEO Larry Reaugh. We'll talk to Ross Clark right after this.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Happy Easter, Ross.
Same to you, Jim. Good to be with you.
Donald Trump starts chatting about lowering the U.S. dollar if he can, and all of a sudden the price of gold hits a 5-month high. Trump and anything to do with the economy seems to be kind of tied together.
Yeah, and he's backing off on a lot of things. I mean, might even look at this point that he's going to be backing Yellen for renewal next February on her term. So things have changed a lot since the days of electioneering and where we are now. And but the one thing is clear: he has continuously talked about trying to keep this U.S. dollar down, to keep things as competitive as possible. It did have an impact on Wednesday, knocked the dollar down and put a bit under the gold market. But on Friday, the dollar did bounce back to a fair degree. But the haven trades, the gold, the silver, the U.S. Treasuries, all have been pretty well bid this week. As a matter of fact, not only did gold hit a 5-month high, but you've got the Treasury market back to where it was almost at the U.S. election, just before interest rates popped up. And we do see the bond market as capable of another 2 or 3 points here on the upside, even though everybody's been talking about higher rates. The reality of it is that on the longer end of the curve, we're not really seeing that. And when I look back on precious metals a week ago, Americans sending the missiles into Syria, immediate overnight impact as far as the gold and silver markets opening dramatically higher and then selling off through the day. And then as we go through this next week, it looks as though there's more and more of a chance of the North Koreans doing a nuclear test. And that's putting anxiety into the markets as well. And, I've looked over the years at gold prices in times of conflict, and it's, you typically will see the strength during events such as this or the lead up to it. And the key is how well they hold afterwards. And so when I look at the action we've had in gold and silver in this last week and a half, we had a big outside reversal day a week ago Friday on the silver market, and that is so typical of a shakeout when we are in the early stages of this 8-year cycle in the gold market. So if the 8-year cycle is bottomed, as we believe it has, then the key now isn't so much where the resistance levels are going to be. It's just a matter of making sure that the supports continue to hold on all the pullbacks as we hopefully just stair-step higher. So we're through 1280 on gold right now. 1245 looks like it is now the new line in the sand on the downside. Anything that would break that in terms of price action would be of major concern, but I think that it looks as though we've got the worst behind us for the metals right now.
Ross, some of the gold bugs have been suggesting we could see gold hit $5,000 an ounce, $10,000 an ounce. Are they being totally unrealistic?
Oh, I never like to listen to projections such as that. I've been hearing them for, so many of the years I've been in the industry. I remember when gold first was $850 and we were looking for 1,000 in the next week, and it took us out into the better part of 18 to 20 years to get to 1,000. So one has to be realistic about things. For the gold market to be that strong, it would have to be a flight from so many items. I mean, you're talking about a very, very weak U.S. dollar if you're pricing it in U.S., and I just don't see that on the horizon right now.
Ross, just before we go, you have a little reminder for our listeners.
Yes, well, just to remind people that I do contribute some of my ChartWorks analysis to Bob Hoye's letter, theinstitutionaladvisors.com, and he does have a trial subscription available there through the end of May. So the earlier that you take it out, the more material you end up seeing.
And with an adjustment in the markets expected in the short term, that's a good idea to stay on top of it.
Oh, yes. I mean, there's clearly the months of March, April, and May are very, very critical in the market, and we've got some analysis that should be of assistance to people.
Ross, have yourself a great Easter.
Thank you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. Coming up, Inside Track President Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, AMY, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik, president of InsideTrack.com, Inside spelled INSIIDE. Welcome back to This Week in Money, Eric.
Oh, thanks for having me back, Jim. Great to be here.
Copper has been called Dr. Copper because many economists feel it gives us a good indication of what direction we're going in and how healthy the economy is. What is happening with copper? It seemed to be pretty hot for, I would say, the first 3 or 4 months of the year.
Yeah, copper is, as you said, it's viewed as a leading indicator, both leading indicator of inflation and deflationary forces, and I'm speaking of commodity prices in that respect, and also a lead indicator of economic growth or retrenchment. And so it is good to watch in that regard. And one of the primary things that I was focused on coming into this year was the wave structure of copper and the advance that it had seen since January of last year. And it was completing a textbook 5-wave advance, and the 4th wave was the pullback into late December, and that's when I started publishing that I thought we should see a final rally into mid-February, and my target was to see a spike above 280, and that would complete almost everything that was necessary and that I expected for a culminating rally and also a 5th wave advance. And although I don't base a lot of my work on just wave structure and Elliott wave count, it is a a valuable backdrop to kind of set the stage for what a lot of my other indicators are saying or soon to signal. So in mid-February, sure enough, copper spiked to new highs, spiked above 280 for a day, and that was when I started explaining that we've seen the fulfillment of just about everything to the upside, and it's time for a 3 to 6 month peak to take hold, and described why the first downside target from there, from above 280, would be a drop to 245, and that's really the critical level that I'm watching, and I think we're going to get there. Most recently, throughout the month of March and first couple days of April, it has traded kind of sideways between 255 and 270, and 270 really kind of set itself up as the make or break resistance level for a secondary peak, and we just hit that in the beginning of April again. Copper triggered some additional sell signals at that point, and from everything I'm seeing, I think we're going to see a quick sharp drop to 245, and what it does there is going to have a pretty strong bearing on what I expect for the next 3 to 6 months. If it breaks below that, we could certainly see it get down into the high 220s, around 227, 228. And that does kind of play into and act as a precursor to some of the other expectations I have. One is in your metals that I think once we get some of the safe haven premium out of gold that it has just experienced in the last week or two, that you could see all the metals retrace during this month, possibly carrying over a little bit into early May. And if you look at silver, it's kind of the classic tug of war between the influence of base metals and industrial metal usage and what's expected to go on in copper very soon, versus the safe haven flight to quality aspect of gold. So you've got silver in the middle of those two, and it has just been bumping up against its early month highs right around 1840, 1850, and not being able to break out, even as gold has embarked on an additional rally and pretty much reached my 1 to 2 month target of 1284. So you kind of have that whole scenario playing out where copper again is leading the way, and wouldn't surprise me to see gold and silver put in some intermediate tops in the very near future, and then follow copper down. And also tied into that whole scenario is my 3 to 6 month outlook for bonds and notes and interest rate vehicles as a whole, that I thought we would see bonds slowly rebound from late 2016 into mid-2017. And now if you get economic indicators like copper starting to show some weakness, that should probably provide a little bit of a floor under some of the interest rate vehicles.
Are you expecting interest rates to go up?
I am in the 1 to 2 year horizon, but not in the 3 to 6 month horizon, and that's going back to recent months when I thought that that late December low would hold in bonds and notes, and that they would slowly but steadily climb into June of 2017. And since that's the inverse of what the underlying interest rates are doing, a rally in bonds and notes is indicative of the rates holding steady, the perception changing slightly, or the timing for future rate hikes. So I think that this year is probably going to be more of a steady as she goes type of thing with conflicting indicators and things that the Fed looks at for interest rate moves. I think they're going to see a big mixed bag, and that will allow bonds and notes to kind of create a trading range for a good part of the year. And then the next leg down in bonds and notes, which would be higher interest rates, or at least the expectation of higher interest rates, I expect that to come into play later this year and then into 2018.
You're listening to This Week in Money. I'm Jim Goddard. We're speaking with Inside Track President Eric Hadik. Now, we've had Donald Trump, as president of the U.S., order the missile strikes into Syria. He's now talking tough about North Korea. Are those factors that you're looking at as well, or do you just look at what the long trend charts are predicting?
Yeah, I'm not looking at them for anything more than maybe multi-day moves in the market, sometimes going with the underlying trend, sometimes going against it. That's what makes an overall trend. It's not straight up or straight down. It's often with a lot of volatility. And so that, as I alluded to a few minutes ago, is one of those things that probably has put a little bit of premium into gold, even as silver has been mixed. And in fact, silver really had its sharpest 2-day sell-off in a month or more, had it immediately after the Syrian missile strike. And so you get a real mixed reaction to that, and unless something really intensifies from there, it's more just volatility in the markets and some trading range. As I also mentioned, it allowed gold to get up to the target that I've had for this rally, around 1284 in the June gold futures. We've gotten very close to that, so gold has fulfilled some of this upside. Right as silver is bumping up against 1850, and then you have these fundamental events which spurred tests of these levels, but has not triggered any break through them. So in that respect, I think that it's kind of on to the next focus, unless something ratchets up to the next level in Syria or in North Korea, then they kind of fade into the background as far as the focus of traders' attention. And you could see a sharp sell-off in some of the, like when I'm talking about metals, or a decent rally in bonds and notes, and then maybe you do get another event that creates a pullback. But a lot of times the underlying trend continues to be the governing force, even as those events trigger reactions within that trend. So, speaking of fundamentals, and I'm not sure if this is a perfect segue here or not, but one of the other fundamental events that I've just recently been talking about really involves the equity markets, and it wouldn't surprise me to see these events in the airline industry of the last few days having a bit more of a fundamental factor on equity markets and on stocks than maybe people anticipate right now.
Well, United Airlines certainly didn't do themselves any favors, that's for sure. Is that going to spill over to other airlines? If their stocks go down, they can take other stocks down with them?
Well, that's what I'm alluding to. And from a broader perspective, let me step back and just quickly enumerate a couple factors that have been on my radar for even a couple years. Number one is the fact that over the last 20 years, most of the big moves in equity markets, to the upside and the downside, have been led by the transportation average. And back in 1999-2000, the transports topped in May of 99, even though the rest of the markets carried over into early 2000, and then you saw the bottom drop out in the ensuing 2 years. When it was bottoming, the transports bottomed first. And this has been a sequence all the way up to recent years when in November, December of 2014, the Dow Jones Transportation Average peaked and began to give signs of a top, even as the rest of the indices didn't top until between April and May. Some even carried over into June of 2015. Meanwhile, the transportation average kept kind of going in a stair-step fashion down, showing that there was some underlying issues that needed to be addressed. And when the transports finally broke through key support in early to mid-August is when all the other indexes kind of gave up the ghost, and you saw this sharp, what amounted to be 15 to 20% drop in the strongest stocks and indices, and as much as a 35-40% drop in a lot of the weaker stocks and indices leading into late August. So again, you had the transports leading that, and then they started to lead on the rebound here lately, and they just, in the last 2 months, retested and slightly spiked above their late 2014 highs, and that's setting up what could be a double top there. And I've been looking for that average, that index, to again give some early warning signs of any trouble in the market. So that's kind of my first point there, is just what the transports are historically known to do. And the second point is where the events of recent days with United Airlines, they have an initial impact primarily on their stock. But if you step back and you listen to the rhetoric and the reaction to it from congressional sources, legislative sources, you see this resurrection of the argument over whether this rebooking and whatnot is a good sound policy. Now, they've since come out and said that United flight wasn't even overbooked. And if I just said rebooking, I meant overbooking. It wasn't overbooked, but that has been one of the topics that has consumed the news talk shows of late, and whether something like that needs to be revisited. And you always get your legislative overreaction to events like this. Certain congressmen and other legislators just run to, immediately go to the opposite extreme, so that they're not viewed as being ignorant of what's going on or placating it in any way. And then the whole pendulum, and then the market overreacts to the legislative overreaction, and you get bigger swings than really are probably justified by any of the fundamental events. But I could certainly see a scenario where you start talking about legislation to address that overbooking, and then all of a sudden investors start to get a little spooked on airline stocks. Oh, wait a minute, is this going to impact profitability? Because that's really the thing why overbooking has worked in the airline's favor. And why, almost every plane you fly on nowadays is full capacity. Which from a business standpoint is smart. It makes a lot of sense. But if they start attacking that policy with legislation, then all of a sudden you're going to get this trickle effect. And then if you get airline stocks, maybe just seeing a modest correction on that, then you get other things. You kind of get the snowball effect. That wouldn't surprise me at all for 6 months from now, people would be looking back and saying, that unfortunate incident with United actually kind of, it's shown a light on a festering issue and catapulted it to the forefront, and then we had all this impulsive reactions that then triggered secondary ramifications and unintended consequences, and that's how you have a lot of these market moves go. So, that's one of many possible scenarios that could start to impact the markets. Obviously, you have a lot of geopolitical irons in the fire that any one of them could certainly trigger some selling in the markets, but it's just really intriguing to me, too, the 17-year cycle that I've talked about with you before, too, and March 2017 is exactly 17 years from the March 2000 peak in the equity market, after which they saw a 2.5-year decline.
We'll have more with Eric Hadik coming up on This Week in Money.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Inside Track President Eric Hadik. He's speaking to us from the Chicago area. Eric, what do you think is going to happen with the major equity markets in the U.S. over the next 6 months?
Well, I have discussed my expectations that where these longer-term cycles are concerned, and I just referenced the 17-year cycle that that's been such a focus of mine for over a decade that I even have an additional website that is 17yearcycle.com. And, you look at the major equity markets and you go back more than 100 years, and that cycle has just been uncanny in timing this sequence, first of major lows and then of major highs. And I should segue real quickly into what I believe is the sequence or the natural progression of cycles. I have an indicator I call a cycle progression, and it illustrates how your most consistent cycles will, in a textbook manner, in a theoretically pure manner, will time 4 consistent lows, and then it will invert and time the next 4 consistent highs. And it does this ongoing kind of a sine wave from under the zero or equilibrium point to above it, then back below it. And so you will see cycles apply like that. That's also why I believe a lot of people get very frustrated with cycles, because they expect them to just keep timing lows or highs ad infinitum, just, off into eternity. And that's not the way I believe that the markets and cycles work, that there are then much bigger cycles swinging that are the reason why you get this vacillation from one extreme to another. So getting back to the 17-year cycle in the equity markets, you go back to the late 1890s. 1898 was a major low. Then 17 years later, in 1915, you saw a major low. Then 17 years later, 1932, the Great Depression low was in 1932. And 17 years later, in 1949, you saw a higher low, and since that is when you expect the cycles in the market to enter an accelerated move up and allow that cycle to then invert and start timing highs, from 49 through 1966, you had that 17-year up phase, where you break through the equilibrium point, you break through the zero line on a sine wave, and now you're into positive territory. And sure enough, 17 years later, 1966, you had a major peak in the stock market, in the equity indices. 17 years after that, 1983, you had a kind of the final high in a wide multi-decade trading range. Market pulled back into 84, and then when it finally took out that 83 high was when the bull market really took off, and it continued until 2000, 17 years later. Well, here we are 17 years after that high, and you've now seen this would be a fourth high in the sequence, 1966, 83, 2000, and then 2017. So this becomes a very significant time for that cycle, but there are a lot of others that are corroborating that. And one of the ones that I elaborated on last year was a 10-year, the decennial cycle. And if you look at the last 8 decades, and I believe it was 13 in the last 16, something like that, the 7-year carrying over into the 8-year, so in this case 2017 carrying into 2018, has seen either domestic in America or some global market panics and sell-offs, and that there are other cycles even corroborating that. So everything was coming together telling me, if you looked at the greatest synergy of all of those cycles and then some timing indicators that I use, they led me to the conclusion that March 2017 to March 2018 would be a bearish phase in multiple cycles, and some key upside targets were reached right before then. So it has me looking for an overall sell-off between now and the first quarter of 2018. And that doesn't mean that it's an all-out crash or anything. Doesn't mean that it happens all at once. In many cases, it takes months for that to really get going. Then you'll see an accelerated move consume a month or so, and then a bottoming process that may take many months.
In North America, we're obsessed with quarterly business cycles. In China, of course, they take a much longer view on planning and cycles and so on. Do you think they would pay more attention to somebody like you with your longer cycles to things instead of doing it every 3 months?
Well, there's so many competing influences, and like you said, you look at even CEOs who know that their head may be on the chopping block if the next quarter doesn't reach all the shareholders' expectations, or you get a couple either anemic or negative quarters. So yes, everything becomes a very short-term time horizon, and that in good times that kind of keeps keeps fueling the engine of the market, and in bad times it really exacerbates things, so you get more volatile swings. And you look at our market since the year 2000, and you've had some pretty big swings. What other period of time within 15, 16 years did you see 3 declines of 30 to 50% in the majority of stocks and indices? Now the most recent one in 2015, 2016 really didn't reflect in, say, the Dow and the S&P, but you look at so many international indices, you look at so many domestic stocks themselves, and in one of my reports, I just listed 40 or 50 of them, and these are all major companies and major stocks, not cherry-picking some little stock that just happened to have an overreaction to the downside, but you had 30 to 50% declines in 2015-16, and again, within a year or more, you're back up to the highs again. That's some serious volatility, and each time it keeps accelerating. When you look at the move from 2000 down to 2002, then back up to 2007, 8, then down to 2009, you're starting to condense the amount of time for those swings That's often very indicative of major transitions, major shifts when you get this intense battle between bulls and bears and accelerated moves in both directions. So I think it's giving some warning signs, too, of things to come.
Eric, the U.S. dollar had an outside month to the downside in January and another one in March. Is this a rare occurrence, and does it signal anything?
I do place some decent significance on outside month moves in either direction. One thing that it has to do for me to take notice is to also give what I call a two-close reversal. So when I see an outside month two-close reversal to the downside, that's far more significant to me. And what I mean by that is if you look at, since January was the first month you're talking about, it spiked to a new high, then by the end of the month it had dropped below the lows of December. So it has a higher high and a lower low. That's what they consider an outside month. When I'm seeing something like that January close, I want it to be below the December close and also below the November close. So the two previous closes, I want that January, that outside month close to be below both of them to reinforce that significance. So that did happen in January, and that ended up continuing to pressure the market into March. But when you saw that outside month in March, the close of the month was a different scenario where it did close a little bit below February's close, but it ended up being significantly higher than where the dollar had closed in January. So it was between the two closes, and it closed at about mid-range of the overall monthly range in March. And whereas you go back to January, that close was at the very bottom of the range. So that is a more significant version of that outside month tick, that outside month signal. So the one in March I don't think was near as significant. So I think that they are giving warning signs, but my outlook all along has been to see the dollar try to give a final push up into May of 2017, and that is when I see the higher likelihood of a final top. So maybe what we do is just go retest the January peak, and maybe we see kind of a similar thing. Maybe April works itself towards those highs, and then May you get another outside month to the downside. So it spikes a little higher to begin May, and then by the end of the month is selling off. At that point in time, what you really should be watching is the March 2017 close, which would be the second close in May. And I hope I'm not confusing your listeners too much, getting into a lot of this technical jargon without some illustrative charts to show along with it. But that would be a more significant and more noteworthy scenario for me, where the dollar is concerned, and it would fit with, I've described a very consistent 3-year cycle in the dollar that timed the mid-2008 bottom. Then that was followed by a secondary low in mid-2011. Then as we were coming into April, May of 2014, I elaborated on these cycles and showed why I thought the euro was in for a collapse and the dollar should see a 3-year uptrend from there. Again, that whole cycle progression I'm talking about, where it goes from low to low to low, then eventually you see one complete 3-year move to the upside. Well, we're coming into the completion of that now in May or June of 2017. And that's when I think we'll see a pretty significant top in the dollar. And that should also usher in some of the other things I'm expecting, like the time when I think gold will have a greater potential to the upside beginning in third quarter and fourth quarter of this year.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, president of InsideTrack.com. Also check out his website, 17yearcycle.com. Coming up, John Kaiser, next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're chatting with John Kaiser, founder of KaiserResearch.com. Welcome to This Week in Money, John.
Jim, it's great to be on your show.
Can you tell us a little bit about Kaiser Research? What do you do?
Kaiser Research tracks the Canadian-listed companies involved in the resource sector. We have about 1,400 right now that are still actively involved in this sector. We provide an information portal, and we also provide recommendations for a small subset of the companies that we cover.
Over this past few months, it's been pretty amazing in the junior mining sector. Can you tell us why?
Well, around sort of mid-June of 2011 was the beginning of what turned out to be a horrific bear market for the resource sector, and in particular the resource juniors. And we saw a turning point in January, late January of 2016 last year, and we had a surprisingly long rally that lasted until mid-August. Now that rally was tracking an uptrend in the price of gold, which the Goldman Sachs of the world were predicting was going to go below $1,000, and instead it almost touched $1,400 before it stalled. The market uptrend, however, stopped on a dime, and even the Trump election failed to really turn things around. But at the end of December of last year, we started to see a rebound in terms of indices. We've seen levels almost back to where they were in mid-August. But what's been really important is the amount of money going into corporate treasuries. And March was a stunning month for the resource companies listed on the TSX Venture Exchange.
How much money has gone into the junior mining business in the short term?
In March, we saw $700 million raised between private placements and short offering memoranda where the stock is instantly free trading by companies that are in the resource sector. About $1 billion was raised in total by the venture exchange, which includes a number of marijuana companies and things like that. But this number, this amount, $700 million, is the biggest by far since June of 2011. And February was also a tremendous month where a cluster of companies led by Osisko Mining Inc. in the Windfall District of Quebec raised $100 million for a massive rethinking of a district that previously has been dismissed as just having small ratty deposits that will never come together to be a mine. A very important thing that's going on is that the focus on higher metal prices, the so-called optionality trade, has shifted to discovery exploration. The street has become tired of the tyranny of the gold price trend. They are now shoving money at companies. Find us projects that work with the metal prices that we have. And of course, ironically, just as this is changing, gold price is starting to trend up in a way that suggests it may have a ways to go.
Working with current prices, that's a new theme, isn't it?
Yes, because is from when the China super cycle kicked in 2003, something that the majors did not realize until 2006. Everything was about rethinking the failures of past exploration cycles, deposits that were dragged into the money by the substantially higher precious and base metal prices, and it was all about feasibility demonstration, and then the majors gobbling up these juniors and talking about, well, this is all going to be wonderful. But gold peaked at 1900, retreated back to 1050. Base metal prices have not retreated back as far, but they have stalled. Costs did a lot of catch-up so that the profit margins everybody had vanished, and the optionality trade became sort of a dud. And with uncertainty about what's going to drive gold price substantially higher, and even metal prices in the absence of a major macroeconomic global growth driver, the focus has returned to exploration, looking at known systems, saying, okay, well, we know that this stuff is here that doesn't really work at the price we have, but do you truly understand the system? If we give you money, can your geologists come up with ways of perhaps finding a bigger and better deposit? And of course, the classic example was Oyu Tolgoi, a copper-gold system in Mongolia that Robert Friedland's Ivanhoe acquired from BHP. A near-surface system, didn't work at the metal prices then. Friedland went in there and did some deep geophysics and deep drilling and found the Hugo Dummett zone, which was substantially bigger and richer. This is the sort of model of what is now driving the exploration dollars going into the junior treasuries.
You talked before we went on air about the PDAC curse. That's the Prospector Development Conference. It's held annually in Toronto in the spring. Is that happening again this year?
This year, the PDAC curse was anticipated in mid-February. We could feel the market stall. It has been going sideways. In fact, it's really interesting that value traded on the venture exchange was the same in February and March, but we saw this tremendous spike of money going into the treasuries. In April, of course, we're in the tax filing season where people are distracted by having to file their taxes, and supposedly we are facing the sell in May and go away factor. However, we kind of had the stall already. I think this will be a year that the PDAC curse gets violated. There will be a lot of money going into the ground. There is not this kill shot sniper mentality where you need to take $200,000 and drill one hole that delivers a Barnberry intersection. The market is becoming receptive to incrementally positive news and willing to push up the value of the junior. That is a sign of an emerging bull market. I think by the final quarter of this year, this market will be trading at substantially higher levels, much bigger volume and value, and a retail audience will be flooding back into this space.
The over $700 million raised recently, was that evenly distributed among the juniors?
No, the system in its entirety, there's about 1,200 TSX venture companies. 700 of them still have less than $200,000 working capital. Most of them have negative working capital. This is based, of course, on the last sort of financials filed in September. We should be getting the 2016 December year-end financials in soon. We'll see if anything improved. However, during that last quarter of last year when the market stalled, the funding activity also subsided. So it's about 300 to 400 companies which are dominating the raising of the money. They have about $2 billion in their treasury right now. The other ones owe about just under $2 billion. And this is good because a lot of these other ones was are lifestyle-type groups that really don't know how to put together a good program and a technical team to execute true value creation.
Is that something that Kaiser Research does a good job of finding out who does have the expertise and who's really just a bunch of suits and ties sitting around hoping that something good's going to happen?
Well, one of the special features which is really unmatched by any other information portal is our search engine. which allows you to filter out the companies that do have money. We have something called a people tree, where you click on the company, you can see who all the officers, directors, and insiders are, and then you can sort of follow them and see what companies they are or were involved with, and you can get a sense of which groups have accomplishments to their past and which have just a string of rolled back companies that have accomplished nothing, early stage prospects, some little outcrop somewhere with no real story to get excited about. We make it very easy for you to discard all the fluff and home in on the serious juniors.
Track record really does make a difference when you're investing in juniors.
Yes, company management teams that understand how to develop a geological hypothesis, how to tell that story to an audience so that it can get the capital, and then spend the capital wisely so that you make or break the hypothesis, not drag it on indefinitely with the news never really making or breaking. That is the sign of a good management team. It knows what it thinks is there, and it knows how to make it or break it.
Sometimes people say having a geologist at the head of a company isn't a good idea because they're not good at sales. Is there a balance?
I use the word team. Single-person companies, whether it's some sort of a MBA-type person who just has consultants, or a geologist who gets lost in all the details of the rocks, those companies, the latter become what I call toiling geologist companies. They never get any traction. They don't really understand the market. They don't know how to sell the story. They're interested in the rocks. They're interested in being out in the bush and overseeing the drill program. But if they can't get the capital, they can't do that. A good team, such as, say, what Probe Metals has assembled under David Palmer, that is what you need to be taken seriously as a discovery-oriented junior.
John, thank you so much for chatting with us.
It's been a pleasure, Jim.
My guest has been John Kaiser, founder of KaiserResearch.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and John Kaiser, and thank you for listening. Coming up right after this show is a company showcase update with American Manganese CEO and President Larry Reaugh. If you have any questions for our show, you can email us at info@howstreet.com. I'm Jim Goddard. Have a great long weekend. We'll be back again next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. We're speaking with Larry Reaugh, President and CEO of American Manganese Incorporated. Welcome back, Larry.
Well, Jim, I'm glad to be back. It's been a couple of weeks since we had a chat.
So what's happening there at American Manganese?
Well, it's been a very busy couple of weeks, and I just got back from Arizona and Phoenix, where I was doing a presentation to a group of an AII investors, and if anybody wants to know what that is, that's a group of retirees that are millionaires and could be billionaires that are right across the United States. There's something like 500 or 600 chapters, and one of the biggest ones is in Scottsdale, and so we had a presentation there, myself and Norm, and we were well received. We had a lot of questions. We met some people that will be big advantage to the company down the road. And, you know, it was just a real successful weekend. Then we had a press release that came out yesterday, and that release generated more interest in the stock. We were able to reach 100% of the critical metals in the lithium-ion EV battery, and those critical metals are cobalt, lithium, nickel, and manganese, and get 100% recovery. So that is a real milestone for the company. And anybody that understands metallurgy would know that seems like we've met all our goalposts, that we've never had a setback in our program of research with Cametco. And Cametco, throughout this work is looking at perhaps that we might be applying for 2 or 3 more patents to cover things that we're discovering along the way. What this release does is it tells you that, okay, we've leached it, we've been done precipitation tests on the cobalt, and we've done precipitation tests on the lithium with high results. We'll be doing precipitation tests on the manganese and the cobalt. We expect the manganese and nickel. We expect the nickel to react much the same as the cobalt has, which has been a very easy job for us to get 100% of the cobalt out, and the manganese will react somewhat the same as the lithium. That said and done, what these tests do is when you file a patent, you've got to optimize your reagent use, your temperatures, your water, and the list just goes on and on and on and on and on. And throughout that, you may discover things that should be patented that could make it an easier process. So, it's tedious work, but we want to be able to paper that patent so it's totally airtight. And that's important to the company and the shareholders. So, that's coming off, and it's working very well. Cametco's doing a fantastic job. So I can't say enough about that we're very encouraged with everything that we're doing. Back on January the 16th, I put a release out what the value of the cathode materials were in lithium-ion batteries for EV cars, and you can see that there's a very high value. And that just brings us to the point of cobalt. Cobalt. It's hitting the news. It's a lot of companies are starting to fly on cobalt, and I don't know if they realize it, but somebody calculated what 500,000 cars of the new Model 3 that's going to be built at the Gigafactory would contain 7,400 tons of cobalt. Now that's about 8% of the world's supply of cobalt, or maybe say 7% of the world's supply of 7 to 8% of the world's supply of cobalt. Where's that going to come from? We know we're running into shortages. We know that in order to get more cobalt out there, we have to increase the capacities of nickel and copper mines, which the prices of those two commodities are not indicative of doing that, because that's the majority of their of the cash flow is in these products. They only get about 1 to 2% of their profits or of their cash flow from cobalt. So that doesn't look like an answer to me. In the meantime, to get a cobalt mine going today, you're looking at, with all the permitting and everything else, we've all gone through it. We've all seen the statistics of how long it takes to make a discovery and then go through the process of environmental work and feasibility studies, native negotiations, and negotiations with interested shareholders or affected shareholders. And that can be up to 10 to 15 years. So what we're looking for is immediate remedies, but there's none on the horizon. Even with recycling, it's not an immediate remedy. It's going to take us 3 years minimum before we could build a commercial plant. And but that's where the cobalt's going to have to come from. It's going to have to be recycled, and so we think we're in the right spot at the right time. Now, the question that I've been getting from my shareholders is, I mentioned on one of our shows that we would probably look at spinning off our mining assets. Well, that's becoming more imperative, although it's not on the immediate horizon, because EMD is hitting the news again, and that's used in could be used in the lithium-manganese batteries, certainly used in the recent chemistries that we just tested, NMC, nickel, manganese, cobalt, and there's talk of big usage in storage batteries with Tesla. So EMD is coming to the front. And as you know, Jim, back in 2010 to 2012, we did a lot of work on EMD with our low-grade deposits in Arizona. We actually produced the EMD from artillery peak ores, and using the chemical manganese dioxide process rather than the electrolysis process, electroplating process, we produced working lithium-ion manganese batteries. So it's something that's going to come to the forefront. We're busy, and we're going to be real busy. We've had all kinds of meetings, all kinds of conference calls and everything else on a steady basis this year with interested parties. And so we would like to basically put the focal point of the mining into another company. And the question that I'm trying to address here is, on the bull boards, they say that we're going to, throw out the recycling aspect of the business and leave the American Manganese holding the mining properties. So that's not so. We don't plan to dilute the shareholders in American Manganese at all. This is a benefit to the shareholders, whereas they would get on a ratio. Maybe that ratio could be 1-to-1, but I'm thinking more that it could be up to 1-to-3. That for every American Manganese share that they hold today, they could end up with, say, 1/3, a quarter, 1/2 of a share in a new company. That's a great dividend. I mean, that's a big plus for the shareholders of our company. It's like, wow, we got a bunch of free shares in a new company. And I can't see that as a bad thing. But in the bull boards, they try to make it look like it's a bad thing. I mean, it's called short and distort. So I just wanted to bring that up and pass that by to our audience that this question has come up. And it doesn't mean that we're going to immediately do this. There's other things that we have to do, and there's a cost in doing it. But it's something that's on the board. And now with the interest in electrolytic manganese dioxide, or chemical manganese dioxide, and the interest in cobalt, and we've got high-grade cobalt and gold on our project up in New Hazelton on the Rocher de Boule project, maybe it's time to be able to focus on those, but in another company. And so it's just something that we're batting around in our heads, and we haven't made the move to do that yet. But I thought I'd just explain it, that it's not a bad thing. It's a great thing for the shareholders.
Well, Larry, American Manganese now is attracting a lot of attention. It was even brought up by the Resource Work Society here in BC about how it is helping renew a resource that a lot of people were worried was going to run out.
Well, that's exactly right. It just so happens that this is not an overnight success like most people would believe. It just so happens that we spent the effort and the time and the dollars and to be able to produce manganese, electrolytic metals out of very low-grade deposits in Artillery Peak. People keep forgetting that. All they look at is the grades of the deposits were 2 to 3%. They don't look at the fact that it didn't matter that we could produce electrolytic metals at the same cost as China does out of, say, 45% manganese. So, this is coming to the forefront. We've done that work. We've taken that work, and Cometco has recognized that there were aspects of that patent that would help recover the recycled material from these lithium-ion batteries. So that's, it's sometimes you have to go way back. It's not like it was just last year that we completed the proof of concept. It was like we actually did the base work, the heavy lifting back in 2010 and 11. So we hope that we're going to be a big benefit to the environment. We hope they're going to be a big benefit to the end users of cobalt, and lithium, and nickel, manganese, you name it.
Larry, for new listeners, could you maybe tell us again what the primary mission of American Manganese is and what you've discovered?
Well, our primary issue is the recycling of lithium-ion batteries from electric vehicles, and we qualify that by electric vehicles because it's the one area where you can get a lot of batteries with the same chemistry in one battery. You'll get, for example, on a Tesla battery, there's 12,000 cells. 12,000 cells in that battery, and they're all the same chemistry. Whereas if you look at your laptops and other big users of lithium-ion, they're all different shapes and sizes, and you end up, how do you get that? How do you get that battery disassembled? How do we can recycle it. We could recycle all that material. But somebody else would have to come up with and say, look, we got a way of getting the cathode material out if you could treat it, and then we would do that. But we're focused on EV batteries because it's the fastest growing use of these metals that we've talked about, and it gives you a concentration and a focus of batteries all in one spot. Now, that's not rocket science to figure that out, but we know that we can actually, from all the work that we've done to date, there's every possibility that we'll be successful in recycling the material.
Larry, where can you find American Manganese listed?
American Manganese is listed on the tsx Venture Exchange under the symbol AMY. It's listed on the U.S. Exchange under the symbol AMY.V, and in Frankfurt under the symbol 2M. You can go to our site, which is, by the way, is under renewal, and but you still can go to the old site and get all the information you need at AmericanManganeseInc.com, or you can phone me at 778-574-4444.
Larry, thanks for the update.
You're welcome.
My guest has been Larry Reaugh, CEO and President of American Manganese. We were speaking on April 12th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.